Hello, folks. It is Tuesday, October 17th. It's about 1:30 in the afternoon on the East Coast of the United States. In this video, I will be talking about inflation and bonds and showing you how those two are linked, or at least how I have them linked in my mind. So let me share my screen and we'll jump right in. So there we go, inflation and bonds. Before we do that, let's take a quick look at gold. Here's gold. This is our daily time frame. Nice action. So, we got that big move on Friday, and now we're just in a sideways consolidation, basically bouncing between support on the 50-day moving average, pushing up into resistance at the 200-day moving average and the upper median line of this modified shift pitchfork. So very nice action. MACD buy signal, energy elevated, just good stuff in gold. Silver, similarly, big move on Friday, sideways consolidation, pushing up into resistance, multiple layers of resistance in silver. We've got the 50-day moving average, upper median line of this Andrews pitchfork, and then the lower median line of this modified shift pitchfork. So multiple layers of resistance in silver, MACD on a buy signal, energy very elevated. So nice action in silver. These are the mining stocks, my proxy, a continuation of the uptrend. So even though the metals are consolidating sideways, the mining stocks are continuing to push higher. So nice action today, up another 1.5%. MACD on a buy signal, energy very elevated. Dollar is, hasn't dropped decisively. It's dropped below the simple trend line, tested that level from below and then rolled over. Currently finding support on the 20-day moving average. Note that based on MACD, the dollar is very overbought and due for a correction. So, it wouldn't be surprising to see the dollar head lower from here, but that's not what we're getting. Before we leave the metals, let me point out that in this video, we'll be looking at the bond yield charts and seeing that interest rates are rising. So rising interest rates tend to be a headwind for the precious metals. But even with the action in bonds today, we still got nice action in the precious metals. We're not getting a correction in gold and silver, even though the bonds are bond yields, interest rates are moving higher today. So now let's jump into inflation and bonds. What's the connection? That's what we're going to talk about here. Well, the connection, well, let me start there. Inflation and bonds, what's the connection? So the Fed currently is claiming that they are fighting inflation by raising interest rates. Well, as I have said numerous times, that's bullshit. They're raising interest rates because nobody is buying sovereign bonds, and they are trying to attract natural, legitimate buyers for their debt instruments. And so that's the real reason they are raising interest rates, is to try to sell their debt instruments in the midst of a global debt collapse. But the narrative, the story, is that they are raising interest rates to fight inflation. Well, so based on that narrative, as long as inflation remains elevated and rising, they have to keep raising interest rates. And so that's the connection, is that as long as the Fed maintains their current narrative, they will continue raising interest rates. That's my opinion, that's my bias. As they continue to raise interest rates, we will see held to market securities in the banking industry and throughout I'll call it the retirement industry sector, pension funds, retirement funds, annuities, insurance companies, all of the institutional investors that hold bonds and debt instruments, their level of held to market securities will increase, and consequently, their unreported losses, or as we're in earnings seasons right now, and the banks are currently reporting, we just saw with Bank of America, they have to report their held to market securities, and they have to acknowledge their losses in those securities, but they don't actually have to take those losses. They have to report them. So, and then as held to market levels increase, we will see increasing usage of the Bank Term Funding Program. That's the lending program that the Fed created in March of 23. Supposedly, it's only for 12 months, going to end in March of 2024. It won't. It will be extended indefinitely as banks continue leaning on this program and increasing the level of lending through that program. So now let me go back to basically there's two factors that I want to touch on today in regards to inflation. The first one is food. And so this is the primary, until the activity in the Middle East heats up and oil jumps significantly. And remember that analysts are currently talking about $150 a barrel oil. If we get a conflict in the Middle East, closure of the Straits of Hormuz, $150 a barrel will look like cheap oil. But let's hope that doesn't happen. So anyway, without oil prices increasing or natural gas as we head into winter, we've got two primary factors that will cause inflation to remain high and this is the important point, to continue increasing. So, the narrative out there in the mainstream media, if you listen to them, is that we licked the inflation monster, we've tamed the beast, etc. We brought inflation down from 9%. Currently, it's only 4%. Well, that's all BS. They haven't tamed inflation by any means. Food in particular, let's just run through real quick some of the factors that are contributing and will continue to contribute to rising inflation in food. Well, so water levels in the Panama Canal are currently so low that they're having to restrict the traffic that flows through the canal. And so not only the number of ships, but the level to which those ships are allowed to be loaded. Last I saw, they're only able to load the ships to 40% of capacity. And that's how low water is in the Panama Canal right now, is 40% capacity loading of ships, and also restricting the number of ships flowing through the canal. Then last year we had the Hunga Tonga volcano eruption that injected water and ash into the atmosphere. It's affecting agriculture in the southern hemisphere. Project Ukraine and the related sanctions on Russia. We've got reduced grain output from Russia, very little grain coming out of Ukraine at this point, reduced fertilizer from Russia. We've got fires at food processing plants. We've got chickens and turkeys destroyed because of health reasons. And then we've got farms being shut down because of the forever chemicals. And so anyway, just a laundry list of factors affecting the food industry. And then health insurance. And this is the new one. And I've known for years that all of the numbers that come out of the BLS, the Bureau of Lying Statistics, they're all cooked. They're massaged and manipulated and machinated, uh, you know, until they really are meaningless numbers. But they're still published, and people tend to react to them in the financial industries. Stock market goes up and down based on numbers published by the BLS. But so anyway, I stopped digging into the details of how all those numbers are manipulated. But recently it came across my desk, health insurance. And so interestingly, so the BLS doesn't use our monthly health insurance payment, the money that we're actually writing a check for or allowing to be withdrawn from our paycheck. That's not what they use as a measure of inflation for health insurance. What they look at is the profits at the health insurance companies. It's just mind-boggling to me. I mean, clearly there's a connection between the two, the amount of money we pay for health insurance and profits at the companies, but basing inflation in that particular item on the profit levels at the health insurers, again, mind-boggling. So anyway, so health insurance inflation numbers based on profits at the health insurers. Those numbers were affected by the pandemic. And so during the height of the pandemic, nobody was going to their doctors, hospitals, elective surgeries, etc., because they were afraid of, got to hover or cower at home with my mask and etc., 3 masks if you listen to Fauci. And so anyway, they were not using their medical facilities. And so that affected the numbers during 2020 and 2021. And then as we came out of the pandemic, people started using their health insurance again. And so that affected profits. And so anyway, for the last year, the level of measured or reported, I guess would be a better word, the reported inflation in health insurance was suppressed, and suppressed by 3 or 4 or 5% for a whole year. But that suppression ended with the September CPI report. So we've seen the end of the effect in health insurance inflation based on the machinations that the BLS does. And so anyway, what is expected for the next 12 months is that every month we will see the reported inflation in health insurance rise by 1%. And so again, I shouldn't be laughing, but it's just, anyway, the point is, this is another factor that will contribute to rising inflation for at least the next 12 months. And so we've got two primary factors, food and health insurance, that will be contributing to higher inflation going forward. These are just, it's not my intention to be a news channel. I don't want to report on the news. And in particular, these days, reporting on the events that are actually occurring on planet Earth puts you in the crosshairs of the censors. And so I actually run a risk by reporting on real world events, because the powers that be don't want you to know. They don't want you to know what's really going on in the world. And so they are censoring the news. And so by reporting the news, I put myself at risk of being censored. I've already got 1 strike against my channel. I think I can get up to 3 strikes before I get removed, deplatformed completely. But anyway, I don't want to just tell you inflation is going to rise. I want to show you that I'm basing that on actual facts. So anyway, let's take a quick run through. I'm not going to dig down to articles. I just want to show you the Google search and the kind of results we get. So this is the Panama Canal restricting traffic, could remain for 10 months. If you want to dig into that topic, there you go. Hunga Tonga volcano, 85% of agriculture households affected to some extent. So, $20.9 million of damage, affecting fisheries. And so anyway, that is a factor in agriculture in the Southern Hemisphere. And to some extent, that it will extend into the Northern Hemisphere as well. This is the fires in the food processing plants. And, this is when you do a search these days on the internet, and the first page of results you find are all fact-checking results. You're on a topic that they don't want you to investigate. And so food processing plant fires, clearly this is a topic that we're not supposed to talk about. The last number that I saw in regards to this was 230 plus food processing plants and facilities. And facilities can be like a food bank, a major food bank, being closed or destroyed one way or another. That counts in this list. This is just another one. This is a fact-checking 95 events. And if you look at the highlights, we're not suspicious, according to authorities. 10 items were duplicates or did not appear to have happened at all. Again, fact-checking. 50 incidents involved thousands of chickens and turkeys being killed because of a highly contagious avian influenza. Well, this is a fact. It's not thousands of chickens, it's millions. We'll see that in the next tabs here. It's millions of chickens and turkeys. And the way they detected this highly contagious avian influenza is via the same PCR test they used and continue to use during the pandemic. And so anyway, the destruction of chickens and turkeys is based on that same PCR test. And if you anyway, I don't want to talk about the PCR test. Okay, so the lists legitimate incidents, so they are acknowledging that some of these events have occurred, but they do not demonstrate that there is an ongoing effort to create food shortages. So basically, they're debunking the conspiracy theory that there is an intentional effort to create food shortages. So anyway, let's keep rolling. This is chickens destroyed, 43 million. And so this is just, this is as of January of this year. So at this point, that's what, 10 months ago, 9 months ago, 43 million chickens. That's a lot of chickens. That's a lot of eggs. What's this? 58. That's even more turkeys. Well, they're poultry. So that's a combination of turkeys and chickens, I would think, when we're talking poultry flocks. That would include both birds, but 59 million birds have been destroyed. And again, 5 days ago. So that's a recent number. So 59 million between turkeys and chickens. That's a lot of food production that's been gone, just gone. and the eggs that came from those birds. So, and then this is the other factor. This at this point so far is fairly minor, as I understand it. But if you haven't seen this yet, we've got these forever chemicals, and these are it's a class of chemicals that they never go away. If they get into the human body is unable to process and eliminate them. They stay in the soils. We don't have any way yet to remediate these chemicals in the soils. And so what's happening is that the EPA? Anyway, organic farms are being closed down, shut down. Their ability to produce food is being eliminated because of these chemicals. And again, it's the regulators coming in and testing and saying, oh, you've got these forever chemicals on your farmland. We can no longer allow you to provide food. Well, one of the main sources of these forever chemicals, let me see if I can find it here. Here we go. PFAS tainted sewage sludge. And so one of the things that has happened over the last decade or so, all of the cities, they process human waste, and one of the outcomes of that processing is that they're left with sludge. And so they started marketing this sludge as fertilizer to the farming industry. And so, I hope you're not eating lunch right now, but so this sewage sludge has been used as fertilizer in the farmlands. And now they're coming out and saying, sorry, guy, that sludge we sold you was tainted with these forever chemicals, and now we're going to have to shut down your farm. So anyway, I don't want to dwell on that, but that's another factor currently affecting food production here in the United States. This is talking about the health insurance. Declined roughly 3 to 4% a month since October 2022. For a year starting in October, will start rising over 1% per month. So anyway, what else we got here? Oh, and this is showing, this is the actual cost. So if we were measuring inflation of health insurance based on actual outlay, the money that you and I spend on our, health insurance, that's what the chart looks like. So starting in 1999 and up through, looks like mid-2022, nothing but up. And yet, based on the numbers that the BLS publishes, health insurance cost somehow has declined. And then this is another in this chart. This is hospital services. So not really, that's not a measure. It's sort of an indirect measure of health insurance costs. If the cost at a hospital has gone up that much, this is since 2008, basically doubled, 100%, doubled since 2008. Well, obviously somebody's got to pay for that. And that's why our health insurance costs have risen so dramatically. And then there's medical care up 57% since 2008. So anyway, I started to say amusing. It's actually sad to think that health insurance has increased that dramatically in cost. So anyway, I just wanted to show you that when I tell you that inflation is going to continue rising, I'm not just pulling that out of my tuchus. There is real world evidence to support my premise that inflation will keep rising. So anyway, let's look at the charts. That's what's actually more interesting to me. I'm a technical analyst. I'm a visual thinker. I like looking at charts. This is the yield on the 1-year Treasury bill in the monthly time frame. Basically just a sideways consolidation. No real changes since the last time we looked at that chart. We will see throughout the rest of the duration curve that interest rates are starting to rise again. Basically, they've been in a sideways, at the short end of the curve anyway, sideways consolidation, as we see here, finding support along the 10-week moving average. But now we're starting to see this week a new or renewed rise, or what I believe is a renewed rise. We can see energy starting to come off of a very low level, still on a sell signal in MACD, but MACD in bull mode, suggesting that the primary trend is to the upside. And obviously, looking at this chart, that's a bullish chart. That's a chart that says, I'm going to go higher. One of the techniques or methods that Tim Morge would talk about, and rest in peace, Tim. I consider him, he was my mentor for Andrew's Pitchforks. That's where I learned Andrew's Pitchforks. Tim was a professional trader for most of 50 years. But anyway, he would talk about an energy coil. And so when you see a vehicle just consolidating in a sideways action like this, he would talk about an energy coil where the vehicle is gathering energy for its next move, and that move is likely to be dramatic. And so when interest rates or the yield on this instrument moves out of this sideways consolidation, it's likely to do so dramatically, impulsively, and in my opinion, it will be to the upside. Could be to the downside. One of the things Tim taught was that you don't know which direction the break will be in, but most likely, given the rest of this chart, the break will be to the upside. Let's keep rolling. Here again, this yield on the 2-year, we're in the weekly time frame. This megaphone pattern tends to resolve to the upside. Notice this week we've got appear to have a surge to the upside, currently up 3% on the week, 3.2%. And this pink bar, that's just my expectation, is that when we get a break above this level, it will be impulsive. We'll get a strong push, a big push higher. The vehicle's already at 5.2%. And so, the next target would be the next round numbers, basically 6%. Here again, or even more so, in the 5-year Treasury note, we're seeing a big move this week. That's 5%. So 5% move this week, and it's only Tuesday. And so that's a strong move higher in the 5-year note. MACD in bull mode on a buy signal, energy very elevated. So strong move higher, 4.8% currently in this vehicle, targeting 5%, and we'll be pushing into the median line of this Andrew's Pitchfork at that point. 7-year bond, again, push higher this week, currently up 5%. Where's the high? So high 4.89%. So again, pushing up into 5%. MACD in bull mode on the buy signal, energy very elevated. 10-year note pushing up into resistance at the median line of this Andrew's Pitchfork. We could talk about that being a sideways consolidation, but actually today it's pushing up, trying to push up above the, up through that resistance. So anyway, push higher, up almost 5% on the week, pushing up into 5% yield. 20-year bond, again, all of these charts are in the weekly time frame. Sideways consolidation, working on resistance at the median line of the shift Pitchfork. MACD in bull mode on a buy signal, energy very elevated. 30-year bond, same thing, sideways consolidation, actually finding support on the median line of this shift pitchfork. MACD in bull mode on a buy signal, energy very elevated, targeting 5.5% up here at the upper median line. I wanted to show just in this, this is a technical analysis thing about Andrew's pitchfork. So sometimes you go to draw a fork on a vehicle and it doesn't really work, and so here we could make that argument. It's like, that's not really a good fork. But notice this line. This is what Tim would call a sliding parallel, because it is a line that is parallel to the lines in the fork, and we can slide it around on the chart. So sliding parallel, and notice that we can put it along the lower points of all of these candles, and it's a simple trend line, but it shows that price or yield in this case was consistently finding support at that level. So even though it dropped below the lower median line of this fork, it's clearly identifying, I don't want to go into frequency. We talk about frequency. Basically, it's the frequency at which this vehicle is oscillating. But again, I don't want to geek out on technical analysis stuff in this video. So let's keep rolling here. So Bank of America just reported earnings. And again, so unrealized losses on securities rose to 131 billion. So basically they're sitting on $130 billion worth of losses. This is their bond portfolio, and we'll look at some charts here shortly that will give us some insight into these losses. What the banking industry and the rest of the retirement sector is doing is that they buy bonds. They don't intend initially, or not in all cases, they don't intend to hold those bonds to maturity. Basically, they're buying them as an investment that they can sell at some point if they want to. But then as those securities, those debt instruments become worth less than what the institution paid for them, what they do is they transfer them onto their held to market book, which held to market means they are going to hold that security until it matures. And so if we're talking about a 10-year bond, they're going to hold that debt instrument for 10 years. So if you buy, bonds can be confusing, but let's just look at this one point. So if you buy a $1,000 bond and you hold it, let's say it's a 10-year bond. If you hold it for 10 years, at the end of that 10-year period, you are guaranteed to get your $1,000 back. There's no question about that. And so it may drop down, it may drop in half. It could drop by 50% during those 10 years. But as long as you hold it for 10 years, you'll get your $1,000 back, as long as you don't have to sell while it's down 50%. And so that's held to market. Because these bonds have dropped in value, they've transferred it onto their held to market books. And now their intention, if they're able to, is to hold it until it matures. Now, if they get forced into a liquidity crisis, like a bank run, where they're forced to sell those debt instruments, they'll have to realize these losses, and there's 130 billion. And so anyway, this is one of the primary reasons that the banking industry is in trouble, is that they are all invested in debt instruments which are worth less than they paid for them. And so they're trying to transfer them to held to market category, or held to maturity, But some of the banks aren't able to do that because they get forced into they need liquidity, and they're forced to sell those bonds even though they are worth less than what they paid for them. So this chart, this is Fred chart. This is showing held to maturity assets, and we can see that the increase started back here in 2012 and a dramatic increase in since 2020. And again, these are banks and institutional investors transferring bonds, debt instruments onto their books as held to maturity assets, which again works for as long as they're not forced into a liquidity crisis. Did I show, looks like I forgot to show the chart of, let me bring it up here because it's relevant. The term facility, will that find it? Term, there we go. This chart shows this is the bank term funding program. So this program was implemented by the Fed March of this year. And as I said earlier, this is to provide liquidity to the banking industry, hopefully, so they aren't forced to sell those debt instruments that are no longer worth what they paid for them. So instead of having to sell those instruments, they can go borrow money from the Fed on favorable terms and hold those books or hold those underwater securities to maturity. So that's just high level, one of the things that's going on in the banking industry. And so anyway, this chart is showing us the extent to which banks are leaning on this facility. And so notice it's currently at, looks like $109 billion. Well, this program is supposed to end in March of 2024, but the banks, let's say you've got a 10-year bond, you've transferred it into your held to maturity bookkeeping. It's only worth half of what you paid for it. And so you went out and you borrowed money from the Fed. Well, if the Fed says, hey, we need that money back, well, the bank is back into they're back at the starting point. They've got this bond that's only worth half of what they paid for it. And what do we do? And so anyway, this facility will not end in March of 2024, although that is the current end date. So now these last charts, I got 4 of them. These are ETFs, which give us some insight into the value of the bonds that the banking industry and the retirement sector, the institutional investors, insurance companies, pension funds, retirement funds, this is insight into the losses that they are experiencing in their debt instruments, that they've invested in. So this is monthly time frame. This is, what is this? GovT. This is the ETF GovT. So the effective duration of the debt instruments in this ETF is 6 years, currently down 24% from, this is March of 2020. So in most of these ETFs, the peak was in March of 2020, which was basically, that was the low in interest rates. When we got interest rate on the 10-year note down to 0.5%, that was the peak in the value of the debt instruments. And since then, they've done nothing but decline. And so what's significant in this chart from a technical analysis perspective is that in the last 2 months, it dropped below what could have been a double bottom. If interest rates were done rising, that could have been a double bottom, and the value of these ETFs might have started to rise. Well, notice that has not occurred. The value of the bonds that these institutions are holding continues to drop, and it's dropping dramatically. And again, from a technical analysis perspective, that's what we're seeing in this chart. That's an ugly chart. This is TLT. So this is 20 plus year duration bonds, government bonds, sovereign debt, monthly time frame. They are down 53%. So again, peak was in March of 2020, currently down 53%, or that was as of the 12th, down 53%. And again, dramatic drop from a technical analysis perspective, dramatic drop lower. Notice rising volume. And so this is a very negative indication, technical analysis. You never want to see volume rising as price declines. That's the sign of a sell-off. And in this case, it indicates bad things are happening in the economic sector, in the banking sector, in the retirement sector. Again, we're in the midst of a global debt collapse. I mean, I've been saying that for at least 6 months now, and I'm sure that to a lot of people that sounds like, oh, he's being flippant. He doesn't know what he's talking about. Any number of those kind of thoughts might be going through your head when I say that, but let me just say it again. We are in the midst of a global debt collapse. You need to protect yourself. Anyway, let's keep rolling here. This is TLH, 10 to 20 year duration, treasury bonds. So again, sovereign debt, monthly time frame, 45% loss. Again, a dramatic drop through what could have been a support level. That's just plain ugly. I didn't draw it, but again, rising volume. Oops. Rising volume as prices dropping. That's a bad sign. It suggests that the decline is continuing, will continue. Just not a pretty picture, folks. So this is SPMB, and this is mortgage-backed bonds. And so, and primarily it is debt issued by, this is Fannie Mae, Ginnie Mae, and I forget what, FHLMC. Let's take a quick look. FHLMC is Freddie Mac. Is that Freddie Mac? Okay, so yeah, Fannie Mae, Ginnie Mae, Freddie Mac. Government agencies, the debt instruments that they issue, that's what this ETF invests in. This one, it's kind of hard to say what is the loss. If we look at March of 2020, and so that was the peak of all the other ETFs that we just looked at. So from that peak, March of 2020, this instrument is down 24%. We can see that it's had some dramatic peaks going back into this 2009, 2010. And I'm assuming that these big spikes here are related to the housing collapse that was, 2006 through 2008. And then the fact that the Fed and other government agencies tried to rescue the housing industry after the collapse. And so I'm guessing that these spikes are related to that. But again, down 24% if we just look at March of 2020. And again, dramatic breakdown below that, what could have been a support level. We're not seeing the rising volume there, which is, I guess, encouraging. Let's see what else. Oh, and we just opened that. So that's all I've got in this video. I've probably gone longer than I intended. Protect yourself, fill up your gas tank, put some extra food in the pantry, keep at least a couple of gallons of water around. Just no telling what might happen at this point. We're living in interesting times. So that's all I got. I'll talk to you soon, folks.